A hard landing is imminent. I'm your host, Steve Van Metre, and thanks for joining me today. And in our headline story, the U.S. services sector is outright crashing, indicating the economy is headed toward a hard landing. And it's payroll Friday, and while the headline number looks good, underneath the covers, there's indications that could cause the Fed to pause. Let's go over to Bloomberg, where we picked today's story up with a headline: U.S. services gauge shrinks unexpectedly in the worst slide since 2020. The Institute for Supply Management's index of services dropped to 49.6 last month, the lowest since May of 2020, from 56.5 in November. And it's real important when you understand how these are read, that when you see a number below 50, it indicates that a sector, in this case the services sector, is starting to contract. Now remember, it went from 56 to 49. That's a pretty big move down. The question we're going to try to figure out, is this just where it's going to stop, or is it going to head much lower? Because if the services sector continues to fall, it's starting to set up the case that the economy is indeed headed to a hard landing, and the Fed has massively over-tightened and gotten this completely wrong. The group's gauge of business activity, which parallels the ISM's factory output index, slumped a whopping 10 points to 54.7 last month. The orders measure slid even more, as both declines were, get this, the largest since April 2020. So what we're seeing now are declines that were largest since we were entering the pandemic and the economy was shutting down. So this isn't a sign that the economy is suddenly booming and growing. What it's telling us is it's massively decelerating here and at a rapid pace. If this were to continue, it tells us in a matter of months, because these ISM reports are leading indicators to the government's hard data, that in a matter of months we're facing a recession. However, while the factory report showed customer inventories were close to appropriate, the services data suggested that firms viewed their stockpiles as too high. The inventory sentiment gauge soared nearly 12 points to 55.9, the highest since June of 2020. And so now you start to think about this inflation story, you start to think about the demand story. So when inventories are rising, what does that tell you? Is demand is falling, and in this case, what it means for price pressure, at least to the upside, well, we should start to see that slow down. And if this inventory can't get moved, well, what it means is prices are indeed coming down. So this move higher in inventory is definitely not a good sign. A measure of prices paid by service providers declined for a second month to 67.6. And while that's the lowest in nearly 2 years, it's still higher than the long-term average. And again, while what this means is prices are still increasing, the rate of price increase is slowing. Now, as this follows the manufacturing sector lower, which we saw the other day, what it means is the services sector, from a pricing standpoint, is going to start shifting from inflation back to disinflation. Meantime, delivery times improved dramatically. The Purchasing Managers Group gauge hit 48.5 in December. Again, at below 50 means faster delivery times, and last month's figure was the lowest in 7 years, suggesting both a pullback in demand and improving logistics. So again, these aren't indicators of inflation. So when delivery times are speeding up, obviously that means there's an issue with either on the demand side that is slowing down, or as the article just suggested, that the logistics from the supply chain side are speeding up to meet things. And again, none of these are indicators of inflation. They're actually starting to tell us that disinflation is building in. And as we know, based on some of the other data, the probabilities that we could see outright deflation sometime this summer or shortly after that, well, those data is suggesting that is coming. The ISM index of services employment dropped below 50 for the second time in the last 3 months, indicating some industries were reporting a decline in payrolls. The report highlighted both the difficulty in backfilling positions and hiring restraint amid ongoing economic uncertainty. So you start to see the big picture here now, and we're going to look at the new order demand here in a moment. But you see prices aren't going up as fast. You're seeing inventories are rising, and so what does that mean for employers who are able to get their orders in even faster because supply chains are smoothing out and working even more efficiently, it means you need fewer employees, and that hiring growth that we need to see the economy experience to keep from hitting this Fed hard landing, well, we're not seeing that. In fact, when we get to the payroll report, again, I want you to keep in mind when we get there, the headline number looks good, but you're seeing this survey data like the ISM saying, look, we are slowing down quickly, and eventually these good headline numbers are going to turn ugly. And now let's take a look at a chart from our friend and chief strategist, Jeff Snyder, who sends me this in email today that new orders from the ISM are plunging. And what that means is the broad services sector ISM is likely to continue to head lower. And indeed, if that happens, what we're likely then to see is unemployment claims start to rise as employers shed workers. Another indication of this, we go to the Philly Fed. Here we see current new orders in blue against current general activity, and new orders indeed lead general activity, again suggesting what we're seeing is not a short-term slowdown in the ISM, but in the services sector, but a much broader problem, because usually the services sector lags the manufacturing sector by several months. What we're seeing is the manufacturing sector start to crash and then almost immediately followed by the services sector, suggesting we're a matter of months away from seeing a significant rise in unemployment claims. And I spoke with a programmer this morning, and he said, here's a preliminary report, C4 CTA-Timer Pro. He said he should have it done this weekend. Now you see a preview. We've got the fast signal, the slow signal, and here you can see the fast signal on the S&P machine starting to go into buying mode, suggesting they'll drag the slower machines up. A wonderful report. Look at the dollar. You see here, the fast machines are moving back long. Will eventually drag the slow machines higher. And again, as I mentioned, this is $20 until that report is out and I get the videos filmed on how to use it. Then for new subscribers, price goes up. Link in the description below. Now let's talk about the payrolls, because as I've suggested so far, the headline number looks pretty good, but it's not always about the headline number, because we know on the show the Bureau of Labor Statistics always finds ways to cook the books, and of course this time they certainly did. U.S. hiring solid while wages cool, a key indicator of what's driving the market today, giving the Fed room to slow hikes. And what we see is 223,000 jobs were created in December, capping a near record year, the unemployment rate dropping to 3.5%. Average hourly earnings, though, rose 0.3% from a month earlier and 4.6% from December 2021 after November's previously eye-popping gain was revised lower. The deceleration is likely welcome news for the Fed, who see wage pressures, particularly in the services sector, as a key hurdle to achieving their 2% inflation goal. And just so we understand kind of what the Fed is up to, they really don't want to see people lose their jobs per se, although that is a way to bring inflation down. They want to see, raises get into more moderate or even lower levels, because they're afraid of what's called a wage price spiral, where you get a raise and you go out and you can afford higher prices, and then of course retailers realize that, so they raise prices, which means that wholesalers can raise prices, and then manufacturers can raise prices, and then it spirals again over and over and over. So the Fed is really afraid of that, so they want you to get raises, but not really big ones, really small ones. Of course, we know from this show that of course wages aren't already keeping up with inflation, so they're already falling behind, and if the Fed gets its way, it's only going to get worse. It's not the Fed wants fewer jobs, it's they want lower wage growth. Here you go, because they're worried about persistent inflation, according to Randall Cosner, former Fed governor. The data, quote, may make it more likely that they go to 25 basis points rather than 50 at February and March meetings. And in reality, if the Fed can avoid a rate hike in February, there won't be one in March, but it will go with this on the table. If they do 25 in February, you can pretty much forget March, because the data suggests, and I wanted you to see that ISM data, is that the economy is not getting better, it's getting worse. It's only a matter of time before it backfills in to the government's headline data. And which is accurate, wage growth indeed slowed down following major revision to the data from Zero Hedge. Remember that 0.6 month-over-month jump in average hourly earnings that freaked the market out? Well, it was revised down to 0.4% today. And of course, we know from Fed mouthpiece Nick Timiraos to the Wall Street Journal, he says, quote, revisions to the average hourly earnings data paint a marginally less worrisome picture for the Fed on wages than the November report. The upturn in wage growth in November, as originally reported, now down to 0.4%. The 4.6% annual wage growth in December was the lowest since August 2021, giving the Fed something they need to slow down the rate hikes, because we know that they are actually concerned that they're going to tighten too much and cause a recession. So this could be the first bit of data that gives the Fed pause into February. And there was more. Not only did average hourly earnings drop, but this is the big one, but so did average hours worked. Now, again, even if you're receiving a high wage, but you work less, that means you take home less money, means you have less money to pay your bills, less money for discretionary spending, and that brings inflation down. So this is a really interesting piece of data. Let's take a look and get deeper, which has a major impact on average wages, and hours have been flat. The decline in average wages should be even more pronounced. So check this out. Here we have the average weekly hours of all employees in blue against the consumer price index on a year-over-year rate of change. And note, we can go back to the great financial crisis, and here we can see weekly hours falling against rising inflation, and next thing you know, inflation comes down. Here you can see weekly hours somewhat moderate in between, say, 2011 and 2019, and inflation was fairly moderate. Notice how wages then, or hours worked, shouldn't say wages, hours worked rose because of the shortfall. That drove inflation. Now you can see hours worked tumbling, telling us inflation is headed lower. And then when we take on the new order index going back to the Philly Fed and overlay average weekly hours, what it suggests is as new orders decline, and it makes sense, you see it right here, and again in the great financial crisis, weekly hours go down. So even if employers don't lay people off, they can still cut their hours. That turns into disinflation. So again, we're seeing things, when you start going away from that headline number and digging into that payroll report, it's not as bullish as the big number looks and could give the Fed some room to pause. Officials who will receive December's consumer price report next week have made it clear they expect to hold interest rates high for some time, and the dovish signal from cooler wage growth was not expected to shift that outlook. But, well, maybe it will, and here you can see the federal funds rate in red now overlaid against the average weekly hours of all employees, and we can see as average weekly hours indeed falls, the Fed eventually starts to cut. You can see that going into the pandemic, and you can see it now. So all signs suggest maybe the Fed ekes away with a 0.25% increase, but more likely headed to a pause, because if they don't slow down and stop and get on the path to lower rates, the U.S. economy is headed toward a hard landing. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.